Hello and welcome to this week's Australian Stock Market Report. Now, this week we're going to look at energy stocks and whether now is the time to buy these stocks. We'll also look at the WAC stocks, which have all been hit badly the past few weeks. Then we'll get into the Australian stock market so I can share with you my thoughts on where it's heading, along with answering all of your questions and looking at stocks for you. Hello, I'm Dale Gillham, the Chief Analyst here at Wealth Within, and we're Australia's most trusted stock market educators. Now, before we move on, thank you for showing your support for our channel and hitting that subscribe button. And remember, as you subscribe, click the little bell on the right of it so you keep up to date with our latest videos. Also, remember to tune into our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. Now, this is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your questions. Now, oil prices have risen strongly since the beginning of this year as both Brent and light sweet crude oil futures are up over 30%, whilst heating oil futures are up over 40%. However, this is not really translated into a rise in energy stocks in the Australian stock market. Now, looking at our oil and gas producers, Santos is the standout performer, having risen over 11% this year, yet three of the other biggest stocks in this sector have not performed well. Woodside, the largest by market capitalisation, is just in the red, whilst Ampol is down around 9%, and Oil Search, whilst up 3%, has really been flat in 2021. Looking at the energy sector as a whole, it rose strongly in January, only to fall away over the following 3 months, with the sector at one stage down last week around 4% for the year. Now, coronavirus cases have dramatically increased in India, which is one of the world's largest importers of oil, and as a consequence, the demand for oil in India has fallen strongly. However, as the rest of the world is starting to open up, there is greater demand for oil, which is currently outstripping supply. Putting a further strain on oil, the Colonial Pipeline, which is the largest pipeline in the US, experienced a ransomware attack last week, resulting in it shutting down for a few days, causing fuel shortages and panic buying in the southeastern states. Now, it is expected to take a few weeks for everything to really get back to normal. Now, with such a strong demand for oil, are Australian oil and gas producers set to rise? Now, the answer is most likely yes, and I believe Santos is well placed to continue its upward trajectory. I also believe Woodside, Ampol and Oil Search will do well in the second half of 2021. That said, you may need to be a little bit patient with the latter three stocks, as they may experience some short-term falls before rising into the end of 2021. Now's the time to get into what were the best and worst performing sectors last week. Now, consumer staples was the best performer, up 1.08%, followed by healthcare up 0.76%, and consumer discretionary, that was down 0.2%. Now, the worst performing sectors included information technology, which was down heavily once again, falling 6.89%, followed by utilities down 2.53% and energy down 1.94%. The best performers in the ASX S&P Top 100 stocks included carsales.com, which was up 13.26%. after being in a trading halt pending the announcement of it acquiring a 49% stake in Trader Interactive, which is based in the USA. The next was Crown Resorts, which was up 7.59% on news of a merger with Star Entertainment Group, followed by Treasury Wines Estates and Computershare, both up over 6% last week. The worst performing stocks included A2 Milk, that was down 21.23%, followed by Xero, down 15.89%, with Appen and Incitec Pivot, both down over 10% last week. So what do I expect in the market moving forward? Well, let's get into the charts for our S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and look at the stocks that you've chosen for me.
A quick reminder before the video starts. This report is an educational tool, and as such, your personal circumstances have not been considered. We hope you enjoy this week's report.
Well, wasn't last week on our stock market quite interesting? We started off the week really well, making a new all-time high before falling away strongly. But let's get into the chart so we can have a really good look about what I think the market's going to do over the coming month. But and as normal, on the left-hand side of the screen is our monthly chart, and on the right-hand side of the screen is our weekly chart. Now, I'm just going to bring up the monthly chart for the first bit just to have a really good look at this. And you can see here, this momentum line, it's not a trend line, that I've drawn, and I drew this back around about here, so about a couple of months ago, and I said the market is folding over a little bit. and it is running through at that real sort of normal, slowing down the momentum. It's not as vertical as what it was, and I think we're going to still keep running on along this, but I think right now we are showing some signs of weakness through here, which could be the sign that we are going to start moving down into the low that I was expecting. Now, over the last month, I've been suggesting our market will probably make something like 7,600 points, which is roughly about up around about where my pointer is right now. So a little bit higher than what we were. Now, last week we made 7419 points. Now, part of the reason why I was thinking we'd do around about 7,600 points between mid-May and the end of May to peak before starting its move down was I thought the market would be a little bit more bullish through here. So, but we've had a sideways move right through from this week here in April. So all of April, we pretty much went sideways. Now, looking at this bar here in the start of April, we rose 196 points in 1 week. So even just a mild rise through here, we would have made 7,600 points quite easily, but I don't think that's achievable right now given what we saw last week. And I'll show you the daily bar so you can see exactly what happened. So here we have Monday, it was up, our market was up nicely strongly, up 98 points. If it had continued on, we would have been quite nice. And as I said, the next couple of weeks, we could have reached up to that 7,600 points quite easily, but then we spent Tuesday, Wednesday and Thursday falling away in the largest fall in sort of percentage terms that we've had in a couple of months. So that was interesting. And Friday, we did open there. We pushed up to a high on Friday of 7,281 points before coming back to close at 7,239 points. So coming off a little bit. So it'll be interesting to see what happens on Monday and through the beginning of this week. If we do see the market show weakness at the start of this week and keep falling away, especially if it falls below that low there, which is from the week ending, get on it, the 23rd of April. So if we start seeing the market fall below 7,166 points, then we could be falling down into the low that I was expecting over the next sort of 2 to 4 weeks. And I do think the market will do that. We are overdue for some sort of major sort of move down to somewhere in the order of 8 to 12%, roughly. Nothing to really panic about, but I think the market needs to come back a little bit before it starts to rise through to the end of the year. And I do think our market will be bullish through the rest of this year, but looking at this, when we're seeing this whole move since November last year, the market really hasn't moved that well. If I get rid of that and put another one on, you'll see here that since this low, about mid-November to current, it's went up 9.53%, and pretty much most of that was a couple of weeks here, a couple of weeks here, and a little bit through there, but nothing too much. So most of the time, I was saying last week, most of the time our market has been trading sideways, around 70% of the time since the COVID low. It's really much been, or 2/3 of the time, it's been trading sideways, not up or down. And we do need to break out of that, and I do think it'll be down over the next week or two into another low, possibly even up to 4 weeks down into another low. But I am prepared for anything to occur. Now, the only thing that we got at the moment, and I've said this before, I think it was my report last week, where I said right now the only certainty we have is that the market is going to be a little bit uncertain, and it is picking its own directions, and no matter what we think, it's going to keep doing what it's wanting to do, because whilst the government's putting stimulus into the economy, it does artificially manoeuvre or manipulate the market. So whilst it's not falling away, it's also not rising, which means the big end of town or the big players in the market aren't heavily investing into the stock market to take it higher, because they possibly think it's a little bit overhead, a little bit overdone, and we do need to have a bit of a retracement. But while people are coming in and retail traders are coming in, and all that stimulus packages is happening and we're pushing it into the marketplace, it can't fall away. So eventually it will start to fall. And it will fall bigger, but right now I don't think we're going to have a big fall. I think it'll be a short one, maybe 2 to 4 weeks, roughly 8 to 12%. But again, I'm still prepared for it to go up in this coming week. So I know a lot of people think, well, just pick a direction, Dale. Is it going up or is it going down? I need to know, because I need to invest. I want to buy stocks. I want to know whether it's going up, or if I want to sell stocks, because you're telling me it's going to go down. That's not the answer to the question. Is it doesn't matter which direction the market goes. You should have a strategy all the time. And to me, I don't really care where the market market goes up or down from today. It just does not matter to me because I already have a plan that if it starts to fall away, what I'm going to do with my own stocks and what I'm going to do with our client stocks. But if it goes up, I've also got a plan for that. So I don't really care what it's going to do. It's just about what is your focus, what is your plan, and looking at 1 to 2 and 3 years out, where are you going to be and how you're going to position yourself. So at this point in time, it's best not to play in the speculation and not trying to get low cap stocks and speculate on those. We have talked about technology stocks a little bit later on when I get in, just in a few minutes time. I'm going to get into those WAC stocks and talk about that, or our technology stocks, to look at those to see where there might be some opportunities there. But that's all for my market report today. But let's go into our questions that you've given me. All right, and the first question we have today is from Nick, who says, "Hey Dale, looking at BHP as long-term dividend-paying stock. It's on an upward trend since the COVID low and currently sitting at an all-time high. Is it a buy or has the ship sailed?" A couple of questions that I've got on there, or a couple of statements that I've got to make on BHP. BHP is not traditionally a dividend play, and yeah, I understand BHP is paying around 5% at this point in time, but it doesn't always do that. It has been raising its dividend of more of late, and possibly it could be that it's raising its dividend simply because it doesn't have anything else to spend its money on. BHP is very much a growth stock. That's why you buy BHP. You never buy BHP, or I don't ever buy BHP for dividend yield or dividend investing. In fact, I don't buy any stock for dividend investing, so I'd rather growth every single time, because a lot of people think with dividends that they're guaranteed. You know, it's going to pay 5%, it's going to continue. So people want that in the bank, if that makes sense. They know it doesn't matter what the stock price is going to do, I'm going to have 5% in the bank, and that's not necessarily the way to look at it, because stocks do change their dividend yields all of the time, and the dividend yield you're getting now may not be the one you're going to get in 12 months or 2 years' time. And right now, BHP has been looking good, and I do agree with you, it has been looking good as a stock, but I would always look for, if I'm looking long-term, I'm looking for long-term growth, not dividend. You make far more money out of growth than you will on dividend. But let's go and have a look at the chart anyway. Now on your screen is BHP. It is, on the left is a monthly chart, on the right's a weekly chart. And if I bring up the monthly chart, you'll see here currently this month, it did make a new all-time high, $51.82. It's been really, really nice, but it hasn't really done much since February. It closed at $49.13, and only last week it closed at $49.57. So it's not looking as super strong as what it was. I think BHP is may have a tiny bit more upside, but I think we're going to see a retracement on BHP. Looking at last week, it did open, it pushed up to that new high at 51.82 and came back and closed on its low. If we start seeing some downward moves on BHP, we may see it fall below that $44.05, and if we do that, it'll probably go down into around that sort of $40 mark here. So I think, no, you haven't missed the boat on BHP. I don't think there's a boat to catch on BHP at the moment. It's not a stock that I'd be looking at putting into my portfolio. I love this stock. It's a really good stock. It's one of the best stocks in Australia to own, but there are times when you own it and times when you don't. Now, that said, if you'd bought BHP back in the 80s and you held it, if you put in $1,000 or $2,000 into BHP back in the 80s and you held it to today and you just keep using your dividends to buy more BHP stocks all the way along, you'd be really, really, really happy. But right now, I think the boat has gone with BHP. I think it's got some downside to happen over the coming months, but then it'll be a nice time to get into it. But again, when the market and the economy starts to really open up properly, we might see that dividend yield with BHP just shrink a little bit, because it would use the cash, instead of paying it out as dividend, it would use it to do more acquisitions and expansions. That's why BHP is a great growth stock, and great growth stocks generally don't pay high dividends or consistently high dividends, because they'll use their cash to go out and build the company and buy more things, buy more assets. And so I'm assuming BHP is paying out more dividends at the moment simply because it doesn't really want to do any more acquisitions and growth at this point in time. But great question. Thank you for asking that. Now, the next question we have is from Suren, who says, could you please talk about OPY? So let's go and have a look at that stock. Now, I'll just bring it up on the screen. So if you look at your screen right now, if I get it up, it's called Open Pay Group. It's part of that whole sort of payment type of system there. We've talked about that a few times, but right now this looks SHIT. It is not a stock that I would be in at the moment. Now, it could have some good fundamentals, it could be making some money, but right now nobody wants to own this. You can see this all-time high back on the 17th of July 2020. It's been falling, we're a couple of months out of being a year of falling away. and I don't see it's going to stop falling anytime soon. So I seriously don't like it. Please do not get into this stock because you think it's cheap. A lot of people think, oh, well, it was up around that $5 mark. So, hey, now at $1.80 or $1.70, it's really cheap. It's not cheap if it keeps falling. If you buy it now and it falls down to 80 cents, is it cheap buying it at $1.70? And the answer is absolutely no. What is it actually worth? And this is sort of like the whack stocks that I'm going to talk about in a second. If stocks are falling away, you don't jump into them. You don't dollar cost averaging. And I know a lot of people talk about it, and I see, just when I go and look on YouTube, you see all these people talking about dollar cost averaging. Dollar cost averaging is not smart. It will cost you money, and people do talk about buying dips, and that will also cost you money, because if you're buying dips, you should only be buying dips in long-term bullish stocks, not stocks that are falling away. And I find a lot of people will get into a stock that's falling away, possibly like this one. If it goes 1 or 2 weeks up, they jump in thinking that it's finished, it's full, it's starting to rise, only for it to turn away and fall away again, and you're catching a falling knife. We've seen that on quite a few, like Afterpay at the moment. We're seeing that on Appen and Incitec and WiseTech. We're seeing people getting into those stocks. A2 milk, classic example. A lot of people have been buying A2 milk as it's falling, thinking they're dollar cost averaging it and thinking they're doing well, thinking they're buying it cheap, and it continues to keep falling away. So stay out of a stock like this. There are so many other stocks that are better placed at this point in time to buy. But as I said, I did really want to get into, before finishing up, I really wanted to look at the WAC stocks. So let's go and have a bit of a look at those now. And I'll talk to you a bit about them, because a lot of people are looking at whether they would get into these stocks. And what I find is people trying to buy cheap, like I was mentioning before. So they're seeing some of these great stocks falling away and thinking, I'm going to put some money into that, for fear of missing out of them when they start to rise, because these stocks can rise beautifully when they start to move. Now, looking at your screen, I've got a watch list of all the WAC stocks, and you can see this is for the year. So this is from 1 January this year. So we're talking about 4 and a bit months there, 4.5 months. We're talking on those stocks. And you're looking at here, you're seeing some massive moves down here. Appen down 55.93% for the year. Altium down 29%. Afterpay down 27%. Xero down 24%. It fell 12% last week just alone. If we look at last week's fall, have a look at that. That's a massive, massive fall. And a lot of people, I do like Xero, and I think this is probably the better stock out of all of those. But right now, looking at this, I would suggest it's going to fall below that low there of $104, and it'll probably keep falling away. You can see here its high back in December was $157.99, $157.99. So my guess is if it falls below there, it's probably going to hit somewhere between $80 and $90 before it does find some support. But when it does turn to move up again, this is going to be a rip snorter. So you do want to get into on a stock like this, but not right now. The sector as a whole, the information technology sector, is down 19%, and you can see WiseTech Global down 15.5%. But let's go and have a look at them each one, just briefly looking at each one on their monthly charts. And you can see here, here's WiseTech. Its all-time high back in September 2019, heavily hit with the COVID low. Moved up, couldn't get really up to a new all-time high back in January this year, and it's fallen away a little bit, but I would suggest it's going to fall below that low there of $25 quite soon, and it'll start moving back down here. And you can see here, I think $18 odd will probably pull that stock up at this point in time, and it may do that over the coming weeks or months. But again, another good looking stock. I do like this stock, but right now it's not something you want to buy. Don't want to get into that. Let's look at Afterpay. And I know this has been the darling of the market, everybody talking about Afterpay constantly, and you're seeing YouTube videos all the time talking about Afterpay. And for good reason. I mean, from that March low, it took off like a rocket, and you can see from the very, very low to the very, very high is 1,898%. So we're talking about from February, March last year, so right through to February this year. In 12 months, it rose, nearly 1,900%. So anybody that took that rise was very, very, well, probably I'd not say lucky, but very, very well, I'll just say lucky. And not everybody would have got into that. But what you would find, a lot of people would have got in up around here. As soon as it hit this sort of area here, so in that area of sort of $100 to $120, $130, that a lot of people would have got in here. So they're not panicking it to get out. But the more this falls away, the more they'll start to panic, and then they'll start dumping and it'll go right back down. So at this point in time, I think we're going to see Afterpay fall away quite heavily. I think we'll probably get somewhere around about $80. If it goes through $80, then it'll probably hit around about 60, and it could even go to around about $40. So they're my price targets on these. So if it does break that $80 mark, expect it'll go to at least 60, possibly down to $40. And at $40, I think it might be a really good buy. But again, I'm not going to say that's the target. If it does hit $40 in the next months before the end of the year, don't just buy it. You need to make sure it's bottomed out and it's starting to rise up. Now let's go into Altium, having a quick look at that. Very volatile stock, as you can see there. So let's go into the monthly chart to smooth that out. And again, you're seeing here, its all-time high was back in February 2020. Had the COVID low, come back up again, could not make it through this like a WiseTech, and it's starting to fall away. And now it's fallen through that low there of 24.88. So we're currently sitting at 23.66. Here's the other major low, 23.11. If it falls below that, then it's going to go right below all of us, and it'll probably get right down to, if I look at that, it'll probably get somewhere down to around $10 to $12, I'd say, if it goes through that. So maybe pick up a bit earlier than that, but let's say from about $10 to $14 to $15, it'll probably head down to. So again, this could be a few months away before buying, but don't dollar cost average this down, because you're going to keep buying a falling stock at this point in time. It has high probability of continuing to fall. And now Appen, the biggest fall of the lot, and you can see here, let me go to the monthly to smooth that out for you. And look at that. It's just been devastating, this one. So from August last year, it's fallen super, super heavily. And if I do that from that all-time high to here, we're talking about 75%. It's actually fallen through here. So this is the one I probably like the most, and yet it's the most bearish, and this is why I like it the most. So I think it's probably got a little bit further to fall. So currently we're seeing that high there, $43.10. Currently now it is at about $15, $14, $15. So I think it's possibly got a little bit more downside, but I would expect in the not too distant future it will start to find some support. Now it could go down to let me just put this on. So we could see it get down right down to $4.30. And if it does break this $10.91, it will get down to that $4.30. But that'll probably be the time where you really do need to look at that stock, and it'll probably find some support there and go. But right now, again, all of these stocks aren't buys, but I would stick them on my watch list for the rest of this year. And if some of them hit those sorts of levels, start to find support and start to rise up, then they may be some really good trending stocks for 2022, not for 2021. So they may do okay towards the end of this year. We might find, as I said, the last one that I talked about is Appen. That might find support a bit earlier than the rest of them, but I'd be staying out of the rest of the WAC stocks here in Australia. But again, for next year, I think they'll do very, very, very well. But thank you very much for everybody who sent in a question. I do appreciate your time, or the time you're taking to do that. And thanks for everybody that does send in questions to our channel. We really do appreciate that you take the time to put your fingers on the keyboard. But if you're just sitting there and you're thinking, I'd like to ask this, but I'm afraid, or I might sound silly, or it might be a dumb question, there's no dumb questions. Please just stick them below, get typing, stick them below. Happy to answer those for you. So please do that. And next week I will answer them for you. Now remember, you can still get my book, How to Beat the Managed Funds, for free. So my first book, How to Beat the Managed Funds by 20%. All you need to do is pay the shipping. So there's a click. You all need to do is click the link in the description below. Click that, you'll be able to order the book. Just pay the shipping, we'll send it all out to you, and it'll be a great book for you to help get you into the market, understand why we need to do things, why we have buy and sell signals, money management, position sizing, how to construct your portfolio, and how to do a shed load better in the marketplace. I get so many emails and feedback from people saying we've helped them change how they invest, and they're investing so much better and starting to trade a lot better. So please have a look at getting the book. Click the link below and we'll send it out to you. Also remember, we do on this channel, we do these Monday market reports every single week. So we also do our live stream every Tuesday night, 7 to 8 p.m. Australian Eastern Time. So remember, hit the subscribe button now. Click the bell on the right of it so you know when we upload new videos and go live with our show. That's it for me for today. I'm Dale Gillham, Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.